Ladies and gentlemen, good day and welcome to AU Small Finance Bank Q2 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prince Tiwari, Head Investor Relations. Thank you, and over to you, sir.
Thank you, Michelle, and good morning, everyone, and welcome to AU Small Finance Bank's earnings call for the second quarter of FY24. We thank you all for joining the earlier call early in the morning. As some of you may have seen, we made a major strategic announcement yesterday evening, and we appreciate that you all might want to hear from the management on the strategic thinking and the road ahead. We thus have tweaked the format for today's call a bit. After providing you with brief commentary on the quarterly results, I'll invite our founder and MD and CEO, Mr. Sanjay Agarwal, to share his thoughts on the proposed merger and the way forward. In the interest of time, I have requested Uttamji to kindly skip his business highlights for the current quarter, and post Sanjayji's comment, we will straight away jump into the Q&A session with the participating analysts and investors. Apart from Sanjayji and Uttamji, we also have few senior members of our management team on the call today to answer any questions that you may have. With that, let me start by sharing some of the key operating highlights for the quarter. The overall operating environment for the quarter continued to remain challenging with uncertainties around geopolitics, interest rates, and inflation. We all know about it. While the India looks quite good, the overall festive demand holds, and consumption in the rural and urban looks quite okay, supported by government capex. However, on the liability side, we continue to see competitive pressure amidst tight liquidity and higher inflation, leading to higher interest rate and persistent interest rates. In this backdrop, our second quarter performance remained consistent with the expected outcomes, and we are navigating the headwinds quite deftly. Some key highlights for the quarter: we onboarded 3.6 lakh new customers during the quarter, and our total customer base has now reached 45 lakh customers. We have crossed a landmark of 75,000 crores in deposits and 1 lakh crore in asset book or balance sheet size if you include securitized book. On our overall deposits, it grew by 30% year-on-year basis and 9% quarter-on-quarter basis, supported by a CASA growth of 6% on a quarter-on-quarter basis. However, as I talked about, due to tight liquidity and higher pressure on the interest rates, good credit offtake, there is pressure in CASA mobilization, and our CASA ratio is down by 4% since March 23. We are navigating the challenges and focusing on optimizing the liquidity and managing the cost of funds. We'll continue to lay strong emphasis on CASA and retail deposits. And one key thing we have changed is during the quarter, we have created a new banking unit called Swadesh Banking to maximize organizational effectiveness and focus on the upcoming semi-urban and rural areas to unlock the potential. During the quarter, our peak deposit rates increased by 25 basis points across savings and term deposits, taking our FD rate to 8%, the peak FD rate for non-senior citizens to 8%, and peak savings account bucket at 7 quarter. Consequently, there was an impact on a cost of fund, which increased by about 12 bips from the last quarter, reaching to 6.7%. On an average cost of fund for the first half of the year was 6.64, which is 87 bips more than the September 22. While our costs have gone up, our overall yields have remained flat, and this obviously has some pressure on margins. But what we would like to emphasize is that yield flattishness in the yield is more structural in nature as we move towards a more lower credit cost business and more better risk customers or profiles. Our NIM for the quarter was 5.5 and 5.6% for the first half of the year. Now, this changing mix, where we are moving towards lower yielding franchise businesses like business banking, agri-banking, home loans, will continue to put pressure on margins. As I said, it's structural. However, these businesses are also better credit quality and offer savings in terms of credit cost and OPEX. vis-a-vis our traditional businesses of Wheels and SBL. On the overall NIM, we continue to remain within our guided range for this particular year. Our advances growth for the quarter stood at 2%, and on a year-on-year basis, we grew about 24%. However, we did securitize 2,922 crores of loan assets during the quarter. Gross of securitization, the loan book growth stands at 5% on a quarter-on-quarter basis. 63% of our loan books is now fixed rate and 37% is floating. So our fixed rate retail book will be advantageous once the interest rate cycle turns. A key thing to note is that we continue to see uptick in our disbursement yields. After increasing our disbursement yields by about 28 basis points last quarter, we have additionally, our disbursement yields have gone up by 27 basis points in the current quarter as well, taking the total disbursement yields up by 41 basis points over the last half year compared to FY23. The Wheels business, which saw a disbursement about 3,689 crores, the disbursement IRR was upwards of 15% at 15.06, an increase of 77 basis points on a year-on-year basis and 40 basis sequentially. This is expected to help the margins in the coming years as our lower yielding book created during pandemic in some of these businesses starts receding. Additionally, we have expanded our traditional SBL business to add newer products like business loans for micro entrepreneurs in rural and semi-urban areas, offering cash flow-backed loans without collateral and under the government guarantee program. We have also rebranded our SBL function as micro business loan, as is synonymous with the MSME growing requirements across MSMEs. The asset quality trends continue to remain normal and within the range. While during the quarter, the gross NPA increased by 15 basis points to reach 1.91%. Almost 8 bits of this increase can be attributed to the base effect due to higher securitization volumes of 2,922 crores during the quarter. We assure you that basis our feedback from the ground, there is absolutely no pocket of stress in any particular segment or sector, and the increase in GNPA and consequent credit cost can solely be attributed to seasonality, and we hope to see a strong performance in the last quarter of this financial year, as has been the case over the last 20 years. Our quarterly slippages, we also get comfort that our quarterly slippage ratio has remained similar to last few quarters at about 2%. However, as we exhaust our contingency buffers, which was created during the COVID time, our credit cost has started to get normalized. We have a conservative policy in our unsecured lending where we provide 100% on 180-day past due. So some amount of increased credit cost is on account of write-off from credit card book as well, as that book grows and as is expected in the normal course of business. The PCR on the overall book continues to be at 73%, including technical write-off, and bank still has about 96 crores of additional provisioning or provisioning in the form of contingency and standard restructured assets. In nutshell, we expect the asset quality to remain within our range with no specific pocket of stress or any early warning signals. So far, with recovery expected in the second half of the year. Coming to our cost to income, our overall cost to income for the quarter was 61%, down by 4% from Q2, and we continue to focus on efficiency and headcount efficiency. Our cost to income ratios remains a key monitorable, and for the full year, we expect to land somewhere very similar to last financial year. Our NII growth for the quarter was 15% on a YOY basis, and thus net profit increased to 402 crores, an increase of 17% on a YOY basis. The resulting ROA and ROE stood at 1.7 and 13.9% respectively. The bank remains well capitalized with a capital adequacy ratio of 22.4%. The core PPOP growth, a key measure which has been monitored by analysts and has been one of the biggest concerns, has surged to 28% on a year-on-year basis and 20% on a quarter-on-quarter basis. And this is supported by other income from credit cards and distribution of third-party products, and we believe that this is structural in nature and not a one-off. To prepare ourselves for our next phase of growth, we have also reorganized ourselves into 5 businesses group, which will support the existing SBU structure. The first one is urban branch banking, which will focus on catering to urban affluent market and customers. Second, as I said, Swadesh banking, which is the clubbed with government and wholesale deposits, which will focus on rural banking, financial inclusion, and impact banking strategy. small and marginal farmer lending, and financial and digital inclusion has been embedded along with this Swadesh banking. The third large group which we have formed now is Retail Asset Group, which continues to have our key retail lending businesses, which is Wheels, micro business loans, and home loans, as they are all mapped under one umbrella for building synergies and leveraging benefits, as they share similar geographies, customer profiles, and behavior. Fourth is commercial banking, which continues to operate 4 lending books across business banking, agri-banking, real estate, and NBFC lending. And we are expecting that with the operationalization of our AD1 license by the end of this financial year, trade and transaction banking will be the newest addition to this group. The last but not the least is the digital banking group, where all the digital businesses initiatives of the bank, like credit cards, UPI credit card, QR codes, merchant lending, personal loans, video banking, AU0101, have been brought under one umbrella and one leadership to align strategy and bring synergy under the leadership of Mayank. Notably, our digital products continue to scale. Our credit card business has now reached 7 lakh crores, 7 lakh plus live credit cards with monthly spends of 1,350 crores. Additionally, we opened 54,000 savings accounts via video banking. We went live with our Wheels origination lending system in collaboration with Salesforce and FICO. And so far in the initial phase, our STP rates on the car loans have gone to about 30%, and decline rates have reduced by 50%. In line with our philosophy of Badlav Humse Hai, we did launch our new brand campaign, Soch Badlo or Bank Bhi, featuring our brand ambassador, Ms. Kiara Advani. This campaign was strategically designed to align our objectives of catering to evolving aspirations of our customers and role of women in financial decision-making. We also announced our partnerships with Max Life Insurance, Bajaj Alliance Insurance, Bajaj Alliance Life Insurance, Star Health Insurance as bank assurance partner to further strengthen bank's third-party products offering to its customers. We did, among the key product launches, after the super success of IV Premium League banking program, we have introduced Zenith Plus credit card, a super premium metal credit card program offering luxury and convenience, accompanied by a range of exclusive benefits. We also, on the World Sustainability Day, the bank became one of the few first banks in India to launch a green fixed deposit fully compliant with the RBI's latest framework on green deposits. And this has been assured by CRISIL. We request all of you to kindly open green deposits and make your contribution to the environment. So, all in all, we continue to focus on executing on our strategy for March 27 by emphasizing on building a brand by providing complete suite of products and gaining trust of all our stakeholders. Our latest announcement is a step in this direction and will make us complete as a retail bank across products, geographies, and customer segments. To talk more about our announcement, I now invite our founder and MD and CEO, Mr. Sanjay Agarwal, to share his thoughts on the merger announcement.
Yeah. So thank you, Prince. Good morning, friends, and thanks for joining us early in the morning. Prince has already spoken about last quarter's performance. I strongly believe we remain on course in our business in terms of deposit growth, asset growth, people, and the technology, and are putting our best foot forward to handle challenges, uncertainties due to macroeconomic environment. Now I would speak about the transformative merger we announced last night. As an institution, we have come a long way from our humble background of being in BFC to becoming the largest small finance bank in the country. Throughout our journey, we have believed in our vision of becoming one of the world's most trusted retail bank and have been governed by our dharmas, which are a true reflection of who we are and what we stand for. Another institution which started its journey in a similar fashion and was built up, ground up, is Fincare Small Finance Bank. Fincare has witnessed remarkable growth while pursuing an inclusive business model and created immense impact on lives of millions of people at the bottom of the pyramid. I'm absolutely delightful and thrilled to announce the coming together of these two strong, established, and well-governed SFB franchise with a common charter of promoting financial inclusion. This is just not a merger of two entities. It is a union of shared values, common goals, and a vision for the future. This is an all-stock merger with Fincare Small Finance Bank merging into AU Small Finance Bank, and shares will be issued to all Fincare Small Finance Bank shareholders as per the agreed share swap ratio. The merged entity will have around 2,300 touch points, serving over 98 lakh customers through 43,000 plus employees. I want to share my thoughts on why this merger makes a lot of sense for our bank and what capability it would bring to the AU franchise. First, foremost vision is around Fincare's extremely strong and experienced management team led by Rajiv. The team has been around for many years since Fincare's NBFC days and has shown remarkable resilience while building the business from ground up. Fincare team have a deep understanding of the MFI segment along with a strong connect on the ground, a trait which we share and value very highly. This has helped them face multiple industry-level challenges over the last few years. Second point is around the complementary nature of business, both in terms of geography and the product. The addition of Fincare's touchpoint would accelerate build-out of our pan-India distribution network through doubling of touchpoints from 1,000 plus to now 2,300 across 25 states and UTs. This would significantly increase our presence in South, where 49% of Fincare's touchpoints are located, and add significant presence in Tamil Nadu, Karnataka, Andhra, and Telangana, along with UP and Bihar. Post-merger, over time, we would convert Fincare's smaller MFI-focused branches into AU asset centers and expand product offerings. Merger would help diversify our product portfolio with access to rural, impact, and inclusion-focused MFI business and gold loans. Let me first admit that I had a different view on MFI business previously. However, the industry has proven its resilience over economic cycles. It has emerged stronger with reforms and regulation and having faced multiple challenges over the years. So, promoting financial inclusion by catering to unserved and underserved segments of society is our key objective as an SFB. Lending to small and marginal farmers was a gap in our offering. Merger with Fincare would provide us this capability. Merging with an MFI on a bank platform made more sense from our perspective given common regulatory and compliance requirement. Fincare is a well-governed bank with a strong board and marquee private equity investors. MFI has grown a CAGR of 32% over the last 10 years actually. India's strong and widespread economic growth, and I believe that industry is poised for a sustainable growth and profitable nature. Hence, we took this decision. Finally, in my opinion, Fincare has one of the most experienced MFI in the country with a strong collection expertise and ability to sustainable grow the business. Post-merger, MFI would be 8% of our balance sheet, and we would intend to keep it around 10% of our balance sheet going forward. We have also looked through our cyclic profitability and credit costs in the sector, and we believe MFI can sustainably produce ROA of 3.24% on a through-the-cycle basis with credit cost of 2.5 to 3%. We will provision the business conservatively on through-the-cycle basis. Along with the MFI capability, we also benefit from Fincare's gold loan capability, which has a gross advances of 1,100 crore and gained further scale in HL and macro business loan. The merger also brings multiple synergy opportunities from funding cost and scale-driven cost synergies over time. This is not a cost-cutting, but benefit that accrue from scale and reduction in future hiring requirements. Fincare has a strong IT team of 200 people and has developed in-house development capabilities around process digitization. This would further add to our tech capabilities and complement our strong customer-facing applications. Finally, I think Fincare's size is ideal in terms of integration. Neither too small, nor too big to integrate. Rajiv will be appointed Deputy CEO of AU SFB post-merger. He will continue to lead the Fincare unit within AU. Additionally, he will jointly lead the IT and digital unit of AU SFB along with me to ensure smooth IT integration post-merger. Detailed plan of operational integration would be worked out post-completion of merger. We have onboarded A1 to help us with the HR aspect of integration too. As always with M&A, there could be some challenges as we integrate the two businesses, but I feel there are more knowns than unknowns. So in the end, just want to assure you that we'll make everything in terms of a better integration, a smooth transition, so that, we emerge as a very strong franchise in coming years. And also want to assure that we are absolutely on course and remain confident of delivering our March 27 strategic agenda. Thank you so much. Good to go, Prince.
Yeah. So, Michelle, we can now open the call for question and answers.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the first question from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Hope I'm audible, sir. Sir, 2 questions. One is on the merger. And, sir, you alluded to the thought process behind it. But, sir, just wanted to understand a little more on how did you think about this merger, how long did you evaluate it, and also, sir, because we are at a size wherein we are like trying to build up our deposit and we are growing very healthy at 25%, was there in the journey, isn't it too early to get into a merger which takes time? Maybe the deal is really good in terms of size and geographical opportunity and the products that they bring in, and with the management team which is quite strong. But doesn't it derail the process, that the way we were going about things over the last 3-4 years and having 20,000 more people, very different culture maybe? How do you think about it? And now unsecured becomes a reasonably large part of our business versus the way we used to run a more secured franchise. How do you think about it? And second question is, sir, on the competitive intensity on our main business. And when we look at this quarter, the yields have remained quite stagnant, and we've created a reasonable sized balance sheet over the last 3-4 quarters as well. So is there competitive intensity that is leading to yield not getting passed on to the customer? Or if you can just throw some light on what's happening on the yield front, wherein the margins are down to 5.5%. So these 2 questions, one on AU and second is on the merger. Thank you.
Yeah, Bhavik. So let me answer the first one. So, as you know that we are, in my opinion, we are one of that franchise which has become much stable, having a confidence in last 6 years. You know that our overall deposit franchise or asset franchise or digital franchise, overall governance, everything remain in shape, and I'm very happy the way we have built ourselves in the last 6 years. And, there won't be in my opinion, in my journey of entrepreneurship, you can't time yourself, right? It is about the availability. It is about the opportunity of that time which we need to understand and, and decide, right? And as you know that the overall objective of SFB is also to create an impact in the overall customer across segments, right? And we were missing the macrofinance as a subject from last maybe now 28 years. You know that, I had my own stand around the MFI business and, of course, the overall unsecured piece. But, we need to evolve ourselves, we need to understand the risk around it. And we have seen that through cycles, in the last 10 years. The MFI business has cost of around maybe 3% kind of credit cost, including the one-off events every 5 years, right? So I think if you understand that, we being a bank franchise, we have a cost of an advantage. Fincare is more of a south-based franchise. We are more of a northwest franchise. So it's complement, right? So it's complement in terms of geography, complement in terms of product. It's not, anything is not overlapping. And as I already commented that, size is amazing, right? Because the size of Fincare is around, or 20% of us, right? So I think it's this way I want to sum up that it is one of the most, I am very excited and thrilled because it will add on to our product range, it will add on to our geographies, it is well governed, it is bank, and we as a team also have to learn how to do all this kind of integration, all these kind of challenges, how you should manage this kind of challenges, the communication and everything. So, and what we have already done over the years, should give you people a confidence that this team has the ability to manage this kind of transaction also. And, of course, we haven't took much time to decide this. We all started understanding this business from last maybe 2 quarters. And I think I should give my team and the Fincare team and entire people who handled this transition so swiftly and so smoothly that we are able to announce in this month only, right? So that is there. But I would say that much around operation data will share. But I'm absolutely sure that, AU team will deliver along with the Fincare team maybe next 6 months, an amazing franchise which can last forever, and so that's there. Of course, the overall competitive space remains, I would say, more challenging in the terms that, of course, there is a huge credit demand there, but there is an intense competition around deposit franchise. Every bank is looking to build their own, and we as a bank are also on the same course. We are also putting our best foot forward to raise money at a decent rate, but sometimes, market doesn't allow you. And but I think in terms of our product offering, communication, customer focus, ability, so that is there. So I think it's a testing time for us. And I strongly believe that we will sail through it. There would be some couple of more quarter challenge. But in the long term, I strongly believe that we are on the course of our March 27 agenda, where we believe that our first 10 years should be very noise-free. We should remain focused on our execution. We should remain on course in terms of achieving everything in terms of asset growth, asset quality, digital franchise. So overall, I'm very happy the way we are building us. There are little hiccups, but which we should manage it because it is beyond our control.
Right. So on that yield front, we've not been able to price the assets higher. So my question was more on that. Is there competitive intensity too high, or are we, like Prince mentioned, we are going towards better quality customers? Is that leading to yields dropping? Because I see every segment, our yields have increased on a YOY basis, but the overall yields tend to not increase. So just on that perspective, if you or Prince could just throw some light.
So Bhavik, Prince here. Again, what you are seeing today on an overall basis, like as I said in the call as well, in the opening remarks as well, that we have been able to increase the disbursement yields in some of the core businesses, right? The vehicles has gone up by 77 basis points over the last year. Similarly, in the SBL also, while we have not really been able to increase disbursement yields, but the profile is changing. But I think fundamentally what you have to appreciate is the structure of the business, right? The commercial, the overall business construct is changing a bit, and which we have articulated in earlier calls as well. If you go back to March 22, our overall lower yielding businesses, which we are calling commercial banking and home loans, which yield about 11.5%. That used to be about 23%. As on date, as on September, it has now reached to about 31%. And consequently, there is a mixed change that's happening in the business. The higher yielding businesses of Wheels and SBL or MBL are coming down, whereas home loans and commercial banking has gone up. But we have also articulated in slide 30 of Q4 FY23 that the lower yield doesn't necessarily mean a lower ROA, right? The credit cost in these businesses is much, much lower. The OPEX in these businesses are much, much lower. And to that extent, if my retail business gives me a ROA of about 3.8%, on an advances basis, the commercial banking also gives us about a 3.3% ROA, right, and which is already there. One last thing I'd like to articulate is even within the existing businesses like MBL and Wheels, like in Wheels, our personal car segments have gone up. In MBL, our ticket sizes have gone up post-COVID. So earlier, if you look at March 2021 data, are more than 10 lakhs as a ticket size. It used to be about 56%. And that's a lower yielding book compared to less than 10 lakhs where you have more options to price better. This book we have now increased in the new disbursements as on March of 23. 71% is more than 10 lakhs and lesser than 10 lakhs is only 30%. So what we also realized during COVID is the vulnerability of the customer who is over-leveraged and has a smaller business tends to be more risky as compared to people who have a higher borrowing and thus have a more settled business, right? So I think structurally you will find that our credit cost, which used to be about 1%, 80 basis points to 1% through the cycle, will now probably stabilize at about 50 to 60 basis points as we move forward. And that's also an impact of the, so while we might not be able to increase the overall cost yields, but definitely there's a saving in the credit cost. Last point that I will make on that is also the Wheels and SBL, mostly Wheels. Some of the business that we created during the pandemic time, because there was abundant liquidity, and that business did get created because we were very cautious, the credit filters were too tight. We did create a business which was slightly lower yielding as compared to historically where we have been. And that book is ensuring that even though the newer disbursements are happening at a higher yield, that book will slowly start receding now, and probably going into next year, you'll start seeing some uptick in the yields. So hope that's comprehensive, Bhavik.
Yeah, thank you.
Thank you. We'll take the next question from the line of Renish from ICICI Securities. Please go ahead.
Hi, sir. So just two questions from my side. One is on the, the fee income part, wherein the general banking fees have seen a very sharp jump in Q2, from 55 odd crore in Q1 to almost 130 crore in Q2. So can you please throw some light on what is driving this sudden jump in this fee income line, and whether this is sustainable or not?
So it's a sustainable basis. Mainly it's related to insurance where we have the other insurance partners and our insurance income, insurance business is also increasing. So it's a sustainable basis.
And also the
there
credit
is no
card.
one-off.
There's a credit card. If you see, Renish, the credit card fee, I mean, we have been saying this all along, right?
Yeah.
Almost for 2 years.
Yeah, Sanjay this side. So I think, this is well laid down strategy of last maybe couple of years where we have focused on our insurance business. We have really want to build a wealth proposition for our customers. We really want to build our credit card business. And as we move forward, once we get our 81 operationalized, you will see much other income coming in. And, that, once we get customer on board through our branch banking franchise, we need to cross-sell them so that the relationship become more deepened and the relationship also become more fruitful, right? So I think as we move forward, and there is an rationalization around the other industry also in terms of the governance and the compliance. So that is also helping us. So you will see much our other income coming up, and it will be sustainable and more predictable.
Got it. So, I mean, this quarter, there is nothing new which we have done. It is just the past investment which has started giving these results.
Right.
Okay.
In my opinion, we haven't sold any PSL also.
Yes.
So,
there's no one-off.
So there is no one-off, and as we move forward, post this merger, we will have an ability to have more PSL book, and then we'll have an ability to have more PSL income too.
Got it. No, sir, actually, my question is on the one line item, which is general banking and deposit related fees, which has gone up from 55 crore to 130.
which is where
I don't know whether that captures the insurance income or not.
Yes, Ranish, that captures the cross-sell third-party distribution as well.
Okay. Got it. And so secondly, again on this, the merger part, so the employee addition is close to 20,000, wherein I will say which is similar to our size as of now. So once we start the integration process, there will be a lot of management bandwidth which will go into, this integration part, whether it is HR or tech integration. Does that possess a risk of some growth derailment at the standalone entity?
So, no, I think good question, Ranesh. So let me address two things first. Like Prince just announced that we already built our 5 business units, which is around urban banking, Swadesh banking, digital bank, retail asset and commercial banking. And, we have built it not yesterday, we are doing it from last 6 years. And the whole purpose to build these business units are to bring more effectiveness, more focus, and the leadership itself takes care of their own bandwidth and their own agenda and their own commitment towards an overall organization alignment. So I don't think that there would be any derailment because Rajiv and his team is also very capable. They are doing this business for the last, 20 years. And the more I meet them, the more I get a confidence that, this team has also not only performed in good days, I think this team has actually built their businesses through bad days and very low from lows of the industry, right? So they bring that resilience, the fighting spirit on table, which AU is known for. And I think we don't want to integrate them, in the sense that it will be like a FinCare unit in a bank, which will take care of their own business. Of course, there would be some necessary alignment, right, around liability franchise or maybe, around the control functions. But I strongly believe that FinCare Bank will become FinCare unit and they will continue to work as usual. So I think there won't be any such bandwidth issue with the business heads of AU. Of course, the back-end people, me and, the other leadership need to give them some time to have that belongingness, to have that communication, that coordination so that it becomes a very smooth integration. And, just for a data sake, it's not about 20,000 people. It is around 15,000 people and we are at 30,000 people. So they are 1/3 of us. And, most of the 15,000 people, maybe around 2/3 of them are in MFI segment, which we don't have, right? So I think that is why I'm saying that it's more knowns than unknowns. Complete complementary in terms of geography, product, people, and the way we have thought through, you people will have, I know, the anxieties and, because of the track record of so many M&A. But I can assure you that, again, AU will try to build or will try to show that, this integration, this M&A can be so different from the previous ones, and that's our commitment. That's our commitment to ourselves. And I think me and Rajiv are bent upon to execute on those lines.
Got it, sir. Just last thing. So does this merger, will have any impact on cost maybe over next couple of quarters?
No, so I don't think that there would be any additional cost. As I commented that there would be some synergy, but it will be only in next maybe 2 to 3 years. But I don't think there will be any additional cost. There would be one-off cost like, transition around stamp duties, maybe a retention bonus and all those things. But it will be taken care by, we have built it in our future ROE expectations.
Got it, sir. Okay, that's it from my side and best of luck, sir.
Thank you, sir.
Thank you, Ranesh. Thank you.
Thank you. We'll take the next question from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, if we look at AU Bank, it has had certain strengths in its business model, which has enabled it to deliver strong performance over the years. So I just want to understand, when you were evaluating this transaction with FinCare, what, as per you, are the key strengths in the business model of Fincare, other than the complementary geographical presence and MFI book that comes in? So on the core business understanding perspective, if there's something which differentiates Fincare, that was one. And second, sir, associated question here is that we have been following a contiguous expansion strategy as we were expanding geographies. Now, with Fincare, while South geography gets added, but the product profile was relatively different. So we probably don't have that understanding of the geography. So does this expansion, will it take time to drive operating synergies, or how should one look at it from that angle? This was the first question.
Yeah. Should I reply now, or you want to ask second one?
So maybe you can reply that, and then I'll take the second one.
Yeah. Okay. Fine. So I think a brilliant question. So I think you're absolutely right that we had a long-standing position that we don't want to do microfinance as a subject, but we also have gone through our own evolution mindset in terms of what we should do or what we should not do on a bank platform, and microfinance also has gone through all those up and downs in the last maybe 15 years. But I think if you see now, the whole regulation framework, the focus, the kind of support the entire ecosystem is giving to this segment is tremendous, right? And we as a bank also have to have some objective around priority sector norms, the inclusion impact. So I think microfinance is one product which can fulfill all these things, So I think we changed our mindset that, we have to relook this strategy of not looking towards microfinance business at all. And last maybe 2 quarters, I commented that, we really want to build more organically, and we started on that path. But once I met Rajiv and the team in maybe 2 quarters back and figured out their own experience around building this business from grounds up, and this team has really managed their remarkable growth in spite of so many challenges over the years, be it 2008 challenge, 10 challenge, maybe around 2016-17, and then, of course, again in 2020 post-COVID. But they have always become more stronger, and they have emerged better from every crisis, right? So you need to have the best team to handle this kind of business, right? And that remain our core in our whole ethos, right? It's people who matters, right? And that is why if you see our journey, whether it's being now credit card journey or a commercial bank journey or maybe retail assets, we have done phenomenally well because we back people, right? So we as in bank thought, and let's back people, who has done so much hard work, who has a fighting spirit, who understand his business in and out, and they have shown their entrepreneurial mindset to come out from all those challenges, right? So I think first the business segment itself, and then the team which we are getting is tremendous, right? I think these are 2 things which, in my opinion, made us more in favor to merge the entity with us. And of course, then the complementary nature that, they are more south, they have maybe 49% touch point in south, which we don't go naturally. We need to understand people's psyche. We need to understand, overall psyche of people who want to join us. So it gives us in an easy way, or maybe a foot in door to understand those markets emotionally. And it's very important to understand markets and people more emotionally because that's the way we operate in India. So that's one. Second thing. And third, I think they are banks, right? So they are well governed. There is a lot of transparency. There is a strong board, strong private equity players who are with them for last maybe now 10, 12 years. So they have shown that they can be with the company for maybe, it's a long time to be for the private equity player to be in the company, right? So I think these are 3, 4 things, which really impressed us a lot. And we could turn around, right? Because there was a lot of purpose on both of the sides that they really want to make this deal happen. And of course, I strongly believe that it is the price is also very right. It was generous from the other side that they accepted our offer. But I strongly believe that price is also very good. And of course, then the size is not too big, not too small. So I think there are 4, 5 things which and which we believe that is unfair to do this business. So very happy. I know there would be some questions around you people, but we will answer it as we move forward, right? So that's one. And any other question?
Sir, on that contiguous expansion piece.
So that is there. So I don't think that we are changing our stance, Rather, we have around 130 odd liability branch like AU in FinCare, which will add on to our overall growth strategy. And we'll rather want to have more rational growth strategy at AU distribution now, because if you're getting around 1,300 touch points, how we can leverage it, how we can make it more effective, right? How we can have these well-rounded distribution built around those centers, So I don't think that. So that's why I'm saying again and again that there are more knowns than unknowns, and we have gone through very thoroughly in terms of overall understanding, and then want to build very, very patiently, So I think the bandwidth issue or the cost issue or the things which we may not control, I don't think as of now we are able to understand that. And I'm sure that there won't be none. So, but small here and there, we should manage it, and we should learn also to manage it.
Sure. Sir, the reason I was asking the question is that, if you look FinCare SFB, they have slippages that are of around 7%, 18%, and 7% in 21-23. Whereas if you look at AU, historically we have had category-leading performances. So nothing stands out. It's what I got as the initial feel in FinCare microfinance business. So that's where I was asking this question. And second thing, sir, in the presentation we have made a comment that the management continues to focus on seamlessly executing our strategy till 27. So does that mean that we are comfortable operating as an SFB for till 27? How should we read that statement?
So, brother, one at a time. So
sure.
Again, I can only say you this because it's difficult to comment everything so upfront. We will cross maybe now 1.25 lakh crore of balance sheet by next March. So the size and the scale and the width, will allow us to take a better informed decisions. So, but what I'm saying is this, that, just now 6.5 years of us, we being in SFB, we had one agenda. We have fulfilled that. There are nothing as such, where we should be worried about. Our asset quality is in amazingly well in shape. Our digital franchise now building up very well. Of course, deposit franchise is not where things comes very easily, but we have well-rounded it through the other product range, be it wealth, be it insurance, be it payments, be it credit cards. So I think, we are walking on that path where, where this franchise will become a formidable force in coming years.
Yeah, and just on your point, Rohan, around the slippages, of course, we all know that the entire MFI industry has gone through a cycle, right? And the pandemic was relatively much harsher on them as compared to a secured lending business. And that's what we have also factored in when Sanjay ji talked about in his opening speech, that through the cycle, if you look at the MFI business, with adequate provisioning, you can generate a high teen ROE. So honestly, while 1 or 2 years, it is prone to event risk, but the trick that we figured out in the last 10 years, given that it has become much more regulated, the players are much more accepted, the overall practices have evolved over a period of time, is to make a very consistent provision even in good times, because that'll take care of you when the event risk strikes.
Sure, sir. Thanks.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good morning, Sanjay and team, and congrats on the merger. A few questions I have. First is on the securitization. We have been going in for higher securitization. This quarter we did around 2,900 crores. So what will be a strategy on the same going forward? And the second one is on the stronger growth that we have reported in commercial assets, along with the securitization again that we are doing, how will that impact the PSL compliance? So if you can share some color as to where bank stands on the overall PSL compliance and how do you see that going forward with the strategy that we are adopting on the securitization front?
Thanks, Nitin. But I think I will ask Prince to reply on this.
Yeah, Nitin. So again, securitization, as we have been saying, that it serves multiple purposes. One, obviously, it diversifies my funding profile, and to that extent, it helps me on the liability side, puts lesser pressure on the team, especially in an environment where the interest rates is high, and we don't want to load up ourselves on the bulk deposits. So securitization obviously proves a way to generate liquidity. Second, it obviously frees up capital, I think, but that's not the main reason. I think the last point or the second part of the question is very apt, where you said that the overall PSL. So our strategy this year is more to sell non-PSL as compared to priority sector assets. And again, so far, whatever we have securitized, bulk of it has been on the non-priority sector lending book that we have. So that also helps me achieve a higher percentage of PSL achievement against the regulatory compliance requirement. So purpose is dual. One is liquidity, but at the same time also ensures that my PSL compliance goes up.
You want to add on something, Vivek?
Yeah. So on the second question on the commercial banking assets, most of the business banking and agri banking, to the extent that 90% of our agri banking and almost 85% of our business banking assets are PSL. The only book which is financial institutional lending, NBFC lending, that's largely NPSL book. And within the real estate also, almost 40% of our advances are actually PSL because we lend to projects which are classified under affordable housing. Is that right? Question, sir? Answer your question?
Yeah, that answers. And then how do you see the overall loan growth, the on-balance sheet advances growth with the securitization approach?
So I think we have already guided, Nitin, that for the full year basis, we are looking to see anywhere around 25% to 26%. Right? I mean, our overall stated ranges stand is that liabilities will drive our asset growth. And when we speak with our liabilities team and given whatever we have been able to do in the first half of the year, of course, Q1 we chose not to grow our deposits because of the liquidity. But I think on the liability side, we can see that we can grow anywhere between 25 to 30% on an annual basis with the constraints around the cost of funds that we want and the kind of deposit mix that we want. So that basically will ensure that we should do our asset business anywhere around 25-26%.
Yep. Okay. So that basically is not changing because if I look at over the first half, we have grown around 10. So we are looking at a 15% growth in the second half now. Broadly around that.
It's around 11%.
11%, yes.
Yeah, broadly.
You're absolutely right.
Right. And something, one more question.
Access, we will securitize.
Got that. And one more question that I have is on the universal banking license plan. And so now after this merger, what are our thoughts on that? Will that get deferred? And any comments around that?
Nitin, again, I repeat one at a time. So the idea is to be very honest, idea is to really build a bank with all-round capabilities, right? So I think universal is one word, which is just comes in every discussion. But if you see AU, maybe in April 24, you will see, with around 30 product lines, and with the cross-selling ability of wealth, insurance, ADML license, that means FX, the payments, the entire credit card, UPI code. So I think I would sincerely believe that, we should be viewed by the people as such, that we have that all-round capabilities in terms of product, in terms of customers, because once we start microfinance, it will add on to a customer range which haven't served at all by us in last maybe 28 years, right? So I think the kind of width, the kind of I would say depth we are building building our franchise. It's very good in my opinion. And then of course once we settle down, we will look for, the next thing, but I would only say that as of now, one at a time.
All right. Sure, Sanjay. Thanks so much. Wish you all the best.
Thank you, Nitin. Thank you.
Thank you. The next question is from the line of Anand Dama from NK Global. Please go ahead.
So thank you for the opportunity. So what is the reason for the 700 crore fund infusion by Fincare SFB? Is it more to do with that basically you want some cleanup act before the merger happens?
No, Anand, I think everybody knows that Fincare was about to launch their own IPO, and they were supposed to raise capital, and they're high leveraged in that sense. So merger will take some more time, right? It is not happening today, tomorrow, right? So, and they need a capital for their own business as usual, right? So their own team their own investor has committed to the team that, they will put this money, and we accepted that, right? So it's that simple, in my opinion.
Yeah, and Anand, on the GNPA side, again on the cleanup act, the book is already fairly clean. As on 30th September, basis the audited financials, the gross NPAs are in the range of 1.6%. And if you see over the last 3 years, or at least last 2 years, definitely, they have written off a lot of COVID-related NPLs. And in fact, basis whatever interactions we have had and the due diligence feedback that we have got, they have been recovering almost, quite a decent chunk out of that written-off portfolio. And the expectation is they might be able to recover more than 10% in the current financial year.
But, basically the HDFC Limited kind of issues also basically had its own issues, when it was merged. So just wondering basically, if this is to do which is the cleanup. So secondly, what will happen about on the holdco structure, whether the holdco will exist for that SFB? And secondly, what is your view that, RBI would take, particularly given that we are acquiring a very healthy SFB?
So what's the second question? The RBI view, sorry?
RBI view on acquiring a healthy SFB.
Healthy SFB.
Okay, no. So I think, thank you for this compliment, So that's not the whole purpose, because we strongly believe that this is a very healthy, very well established, well-governed SFB, and we would go to a regulator to really allow us to do this, but we strongly believe that the kind of complementary position we have to each other, the regulator would be, I would say, would only support this, but it is their own decision. But we will put our best foot forward to convince them. So that's one thing. Second,
on the point that you made around past merger between Disha and Future, I'm guessing that's the question. Now,
holdco. So no, I think the holdco structure, I think that is their own decision to be made once we get to that level. But initial understanding is this, that the holdco investor will get the shares of AU by liquidation. But I think they will take their own decisions, so it's early to comment as of now.
So I was just wondering about, if RBI would take any objection to the merger, because, there is an acquisition of a healthy SFB, whereas I think RBI had given a license for these entities to operate separately.
No, so there is no acquisition. It's a merger.
Sure.
Both will exist.
Yeah. Sir, any concerns that you feel in terms of integration that would come by, and any integration-related costs that you see?
Not much, Anand, because as I already commented that they are more south-based bank. We are more north and west-based bank. 10,000 people work in MFI business, which we don't have, so that they will continue to work with us. The complementary, the function which maybe have the similar kind of job profile would be not more than 100. We need to sit together to understand those things and how we can align them also with the overall strategy of a bank. In terms of tech integration, as you know, the bank is not that big, right? The deposit base is around close to 10,000 crores, and we are working more on Oracle and all those things. So it is more of a now API-led integration. So that should also help us a better transitioning there. So in that sense, and they are well governed in terms of the overall inspections, overall umbrella of regulators. So that is there. So that's why I'm saying there are more knowns than unknowns. And of course, M&A will throw us some kind of challenges as we move forward. But as a team, we need to have that kind of mindset that we will understand those challenges, we'll sit together and try to resolve it, because the common interest is now one. The common interest to really build one of the finest retail franchise for this country.
Sure, sir. Thanks a lot and best wishes.
Thank you, Anand. Thank you.
Thank you. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, hi. Good morning. Thanks for the opportunity and congratulations to the team for this strategic merger. Sir, a couple of questions. One is on the shareholding of Fincare Small Finance Bank. Now, we do understand that there are quite a few private equity players, both at the holdco level as well as the operating bank level. So, as per the DRHP, some of them have expressed their intent to pair some of their holdings as well. So, as a part of the merger agreement, is there any lock-in for the existing shareholders of Fincare SFB or the holdco, or how does that work?
So, Umang, as you rightly said, there are private equities, but they are all at the holdco level, and holdco owns about 80% of the bank. And the merger is between the bank, and the holdco is not a part of the entire merger process. And hence, we will be issuing shares to the holdco. And as Sanjay ji said in the earlier question, the holdco it's a non-operative holdco. They don't have any other assets. So it's up to them to decide. But our understanding is that even if they go for distribution of this asset or the shares of AU to the underlying investors, they'll have to go through a dissolution or a liquidation process, which will take, who knows how much, but the NCLT process is expected to take a longer time. So we don't really expect a lot of liquidity,
And of course, I don't think that there is one of investors who's having a large chunk.
Yes.
It's a well distributed, right? And just all put together, they would be taking around 10%, right? And if they have maybe around 20 investors, so the average out holding won't be more than 1% each, right? So other than one or two, right? Yeah. So
and also we have some investors there who are common, and they would like to probably hold on because they already hold AU. So we don't really see a lot of liquidity flooding the market, over the next at least 15 to 18 months.
Understood. And sorry, just one clarification. The share swap will work in the same fashion for both the promoter entity shareholders as well as some of the public shareholders, right?
Share swap is for all the shareholders, including the ESOP holders.
Understood.
So it'll work at the same ratio.
Understood. Sir, the second question is, again, in part, Sanjay ji has already kind of answered it, but typically the way we have seen in mergers, now we do understand synergies will take some time to kind of show up, but are there any one-off costs which we are foreseeing at this point of time, which can hit us maybe next 6 to 12 months?
Yeah, so by one-off, do you mean sort of integration costs, or is this deal related or some other business related aspect?
I mean deal related, and again to the point on asset quality which Prince and Sanjay ji answered earlier. But I mean, if you look at the headline NPAs and credit costs of Fincare are relatively higher compared to AU, so maybe basis your due diligence, any one-off expenses or stuff like that.
No, so as I said, Umang, the Fincare, again, during the last 2 years, they have provided a lot and written off a lot of book. In fact, they are seeing recovery from that book. So to that extent, they in fact also did a ARC transaction last quarter to sell some of the legacy NPLs in their secured asset book. The microfinance book is already pretty clean. They have a net NPA of about 0.6%. So to that extent, we don't really think there'll be a lot of provision requirement. Their policy on provisioning and write-off on unsecured book continues to be as stringent as ours. They write off their unsecured book at 180 days or provide 100% as 180 days. So we don't really see any major material, provisioning coming to our book just because of the change in the mix. As far as the integration and other costs are concerned, of course, as Sanjay ji alluded, there will be some amount of transaction-related expenses around stamp duty and other things. But that's normal in nature. We don't really see a lot of integration cost because the businesses, as you said, are very complementary. The MFI business can continue to run as a MFI business because you don't really have it. Some of the other businesses are very complementary around the affordable housing finance and around the entire small business loans. So to that extent, we are not really envisaging a large integration cost. Whatever minimal that might come in because of system and other things has already been baked into our ROA profile, as Sanjay ji said.
Perfect. And just one last data point, the 9.9% post-swap equity which the existing shareholders of Fincare SFB will get, does this include the 700 crore capital infusion by promoters or that would be over and above this?
No, absolutely included in that.
Okay, so this is a fully diluted one?
Absolutely.
Okay, perfect.
Including the ESOP holders.
Okay, all right, great. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Shantanu Chaturvedi from BNP Paribas. Please go ahead.
Hi, thank you for the opportunity. Two questions really. One relates to the merger and the other relates to your own business. The first question related to the merger is one of the calling cards of AU, even in its existence as NBFC, was that even while it was present in higher yield and smaller customers and so on and so forth, it was always able to deliver NPAs and credit costs which compared with the best-in-class banks, and there and thereabouts, something that very few other companies have managed. And we know the stories around how Sanjay ji himself was so focused on that the credit culture of the company should remain pristine. So in that context, bringing in an MFI book, where, as you guys are yourselves admitting that every 3-5 years there seems to be, occasional meltdowns, that is the nature of the business, while it's profitable in good times, it is also susceptible to large drops in sporadic events. How does that fit into your credit culture of where every rupee must come back that goes out? That's my first question. And how do you maintain that sanctity across the organization with this new kind of business coming in? And the second question relates to, your segments of wheels and MSME. Now, you have been talking about this. What I want to understand is that, if current cyclical concerns around a lot of new entrants, etc., are holding you back a little bit in terms of higher growth in high-yield segments, when do you expect that to turn? How much of this is a cyclical concern versus a structural concern? Because if I look at the opportunity headroom that you still have, even in existing geographies, including Rajasthan, that seems to be high. So, at what point do you see that turning? And your thoughts about this, does this change basis what is incoming? And a follow-on to that question, now that the book composition, the loan book composition is changing a little bit, there's microfinance coming in, etc., what are you revising your own thoughts regarding what you consider as leverage thresholds for the overall balance sheet? Because that is so critical to your dilution timeline. You have been going in excess of ROE and therefore there's been an opportunity to make your compounding engine larger. Investors have benefited from it. Do these thresholds change? Do the dilution timelines change? This is the evolving new risk parameters within the broader loan portfolio. These are my questions.
No, thank you, Shantanu. Thank you for the kind words. So I will answer the first one because that's very important that, we always discuss that, why AU should not be in a microfinance business or in unsecured profile. But again, we'll say that, the world has changed dramatically over the years. The whole economic cycle has changed dramatically over the years. The whole loan profile, the segment also has changed in India too. We have got much data available now, and as you would have seen that why we started credit card, why we started personal loan also, that it makes your banking franchise complete. Once if a customer is there, and if you don't offer them credit card, if you don't offer them personal loan, they don't feel that you're complete as a banking franchise, right? So I think sometimes it's driven by the customer needs, it's driven by the customer's overall expectation from a banking franchise. And you also have to believe that the team has done tremendously well over the years to understand the risk and understand the execution capability around the difficult product like Wheels and MSME. Those products are not easy, right? But over the years, we have built the overall, I would say, the process, the policies, the overall culture that, how we should lend, how we should collect. And, that is why I'm saying you again and again that once I met Rajiv and his team, and saw their tremendous capability to work under pressure, to work under uncertainties, coming out through those time when nobody was supporting microfinance and to remain there, right? So I found that they also come with a similar kind of mindset, which we have also performed over the years. And microfinance, of course, is not that secured product, but nowadays, by the overall credit culture coming in the country, I think that those segment is also now addressing to the need of the hour. There is no habitual defaulters, there are no over leveraging, there's much compliance has come in, there's much clarity on the ground and all those things, right? So I strongly believe that by virtue of these changes and by virtue of bringing team with so much of confidence, so much of vintage, so much of experience, and again the overall attitude of AU as a team that we won't lose our money, you people need to support us for some time that, we at AU, might change this whole perception also that microfinance is a risky business, right? And, of course, it has its own risk around credit loss, and that is why we are saying that we will provide adequately. We don't want to say that this year the market is good, then we just don't provide anything, right? So I think as we move forward, we will sit together and want to understand the whole cyclic challenges, and of course we want to provide adequately. And I just want to reassure you that, so I don't think that it will create an unnecessary challenge on overall bank's continuity or bank's overall approach towards business. It will be just around 10% of our overall book. It helps us to add on one more customer base. It helps to get, the priority sector requirement, because that we aspire always to have a very sustainable business model. So I think this will add on to all those things. And I think the overall character of AU in the sense that we should have very predictable asset quality will continue. I can assure you that. Of course, I know that this has its own challenges, different challenges, but I believe that because of our experience, because of the way we have taken the calls, the way we execute ourselves on the ground, should help us to maintain similar kind of business as we move forward, right? And so overall, I would say that the business will evolve because that's the way we should be. Because, if you go back in history, when I started, it was only wheel business. Then when we moved on to, we started SBL, which was not heard in the industry. Then we started affordable housing again. So every time we have done something new and has proved that we can very well understand the whole business from the grounds up and can execute very well, right? So I hope that this time also the story won't be different and we'll go on the same path. Okay, so you want to add on? So, Shantanu, I have forget your second question, so when will that grow?
Yeah, the second question related to, whether the core SBL, MSME and wheels business, little bit of slowdown, how much of that is cyclical and structural? And also I asked that, given that the asset mix on a blended basis is changing a little bit because of the acquisition, how does that impact what kind of leverage thresholds you are comfortable with? Does that change? And therefore, how does it impact your dilution timelines, which have been so value accretive for you?
No. I don't think, Shantanu. So I will ask Bhaskarji to comment on our SBL and other business, but I'm not able to understand this dilution piece.
We will continue to hit the market every day.
Typically, Sanjayji, whenever you have grown...
Capital, right?
Yeah.
We will be getting around close to 2,400 net worth. So it will allow us to leverage maybe another one more year on this money. So, but it's very, again, our stated requirement that we don't want to go below 18% kind of capital adequacy. We don't want to leverage more than 8 times. And so I think it all, if the math will be around this, we'll go and raise more capital, right?
Right. But so Sanjay, I'm asking, is any of that changing because of
nothing. Yeah.
Yeah, hi, morning, Shantanu. My name is Bhaskar. Just to answer on both wheels as well as the SBL business, both continue to be on track. It is just a matter of getting our rates adjusted to the cost of fund. And that is the only one reason, because we also do know during the festive season, we have to be a part in the marketplace which gets competitive, and hence we have been building our rate buffer on both the businesses. Otherwise, by design, by structure, by people on the street, we continue to remain, the entire team continues to remain there on the street, and we are doing whatever is in our plan for the year. So truly nothing to, no miss there. It's all going as per plan.
So Bhaskar, basically what I'm asking is, in this year, these core businesses have been doing very well for you, and obviously as you have also highlighted, and it's plain for us to see, there's a lot of headroom there in terms of opportunity for you to sustain long-term high growth. I understand that because of increased competition, you have to hold back a little bit, as a lot of NBFCs, small finance banks have entered, right, and probably not with as much experience as you. What I'm trying to understand is, at what point do you see that cycle turning? What are the evolving realities of that competitive space, if you will?
So, Shantanu, Uttam here. I want to add here that it's not that we are holding ourselves because of competition or because of competitiveness. It's a function of rate, As Bhaskarji has said that our cost of fund a little bit elevated because of our deposit franchise, as we all know in the market. So it's a function of rate for us. And we are already funding at 15%, on a mix of used and new and tractors and two-wheelers. My SBL business is around 14.5%. My housing is around 11.5%. So as you already said that there is enough headroom even in Rajasthan and all the geographies we operate, but we are just holding ourselves because of it's a function of rate. Because enough potential in our present operating geographies, but because of rate only we are holding this. Otherwise, we can have any number of growth and any number of opportunities capturing in these markets. So just as the cycle rates gets evolved, gets slowed down, our deposit franchise is there. We are there to catch on all those opportunities. So it's not because of competition on that. It's our own decision, our conscious approach towards growth. Yeah.
Shantanu, I hope that answers your question.
Yes, thank you. Thank you for the opportunity.
The next question is from the line of Param Subramanian from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. Most of my questions relating to the merger have largely been answered. So just a couple of questions. Firstly, on this securitization which you have done, large amount of securitization in this quarter. So you've also had a very strong deposit growth, right? So could you just explain the reason for the securitization? Your CD ratio has come down, and I'm also seeing the LCR has come down, quarter on quarter. So, you explained that, securitization is helping you on the liquidity front, but I just wanted to understand, how you're looking at it from the perspective that despite having a strong 9% quarter-on-quarter deposit growth, you had to do such a large securitization. That's the first question. I'll come back for the second.
Yeah. So, my friend, we actually plan ourselves for whole year basis, right? So again, I want to comment that, because it is not that it will be available maybe last quarter and when we need the money, right? So I think we as executive need to take decision day in, day out to really see our sustainable growth. And, if you're doing some transition in the month of September, like, what Prince commented, it was non-PSL, non-PSL, a better rate, maybe offered you in September only, right? So I think it's based on those businesses' requirement which we take decisions. Sometimes it doesn't look nice on the balance sheet as such, but, like you're saying that we grow our deposits so well, so why we need to securitize it. But, we can presume that, next 6 months, there will be more intense competition around deposits, right? And the cost may go up, right? So we need to be more smart enough that, what is good as of now, and we need to take that kind of decisions. Sometimes it goes well, sometimes it goes wrong, but that's the way the life is. So I think that's the one thing which we need to appreciate, that whatever we have done over the years, just has helped AU to become more formidable, more stronger, and more sustainable, more reliable, right? So that's one thing, right, which I want to say that, it's very small decision making which we take every day to remain relevant and to remain sustainable, right? Yeah. Please want to add on?
No, just on the LCR point, again, Param, as we had articulated earlier, last quarter we had abundant liquidity, and it was a very conscious strategy to consume whatever excess liquidity buffers that we had. So
Yes, Param. So what Prince mentioned, because in first quarter we had excess liquidity and we decided that we will not grow our deposit much. But this quarter we are on average 125% LCR. So it was a mix of our decision that we will go for some securitization. This quarter we didn't have any PSLC, so it was mix of some deposit rate and securitization.
Yeah, I get that. Just on this again, so your loan book has just grown 2% quarter-on-quarter, right? But your deposits have grown 9% quarter-on-quarter. So does that imply, because if the average LCR has come down, does that imply that most of the deposits were back-ended? Because I still don't get how the LCR could have dropped quarter-on-quarter.
So again, Param, couple of things, okay? The first is the entire securitization is typically back-ended, right? So most of the liquidity impact you'll start seeing in the next quarter, right? Because you end up doing securitization generally as a quarter-end transaction. That's the way the market works. As far as the entire LCR is concerned, if we had higher deposits, you'll also appreciate that we didn't have any deposit growth in Q1. Yes. So to that extent, the quarter two deposit growth at 9%, it cannot really be back-ended. And we have also given the monthly average numbers as well. So you'll not find a lot of variation between the month-end numbers, so the quarter-end numbers and the average numbers for that particular month. It is given on the slide on the liabilities.
Got it. Fair enough. My second question was on the credit cost. I think in your opening comments, you had mentioned something about, the credit cost, some amount of the credit cost being led by the unsecured segments. So now that we are at this, say, credit cost level of, say, 80 basis points, maybe, X of the contingent provisions, we reverse 90 basis point of credit cost this quarter. So sustainably, how do we see this number, evolving going ahead? Yeah, that's it from me. Thanks.
So I don't think it is 90 basis points. Again, there is a base effect, as I said, but having said that, it is about 50 basis points for this particular quarter. And on the mean reversion basis, we are saying that it could go anywhere around 60 basis on a more sustainable number. Rather than 20 or 30 basis points that we have been seeing in the last year. The credit card accounted for 30 crores of write-offs this particular quarter.
Okay. And are we comfortable on that book right now with 30 crore write-off? Or?
Yeah, very comfortable. I think we understand that it's a business which has some amount of inherent risk, and to that extent, our provisioning policies and write-off policies take care of that. Mayank, you want to add anything on that?
So on the credit card book, we are quite comfortable on this piece because we normally provide. We do write-offs at 180 DPD, so that's the reason, and the book is growing. And it's a 2.5 years old book, so we are getting the seasoning now. Maybe another 6 months, we'll be as good as any other industry player. Competition numbers will be there at the NPA numbers. Our book will get seasoned in next 6-7 months.
Yeah, but I think just want to add on here, Sanjay, this side that, we run P&L for every product, right? So Wheels will have his own, the name and of course the own credit cost and vis-a-vis commercial banking will have its own. As we move forward, microfinance will have its own, credit card will have its own. But I think overall we always believe that any asset which gives us a north of 2% ROA, we really want to concentrate and want to build from there, right? So I think you will find that, maybe, on a credit card, our NPLs around maybe 3%, right? Maybe 4% in credit card, in microfinance also. But overall, I strongly believe that every business in next by March 27, will start giving you north of 3%, not a 2% kind of ROA, So that's our basic principle. Just want to put on the table, right? They might have their own names, they might have their own credit costs, but that's the overall principle, right?
Thank you.
Yeah.
Thank you, sir. Thank you so much. I just wanted to understand this 30 crore, is this something that is recurring, that you see will be recurring going ahead, write-offs? Because if I look at that number on an annualized basis on the credit card book,
It'll
credit card 30 crore write-off.
Yes. So if you see in last, we have been growing by 500 crores book every quarter now. In the next 2 quarters, you will see that 400 crores we have already grown in the past 6 months. So it will be 30 crores will be sort of, which will get, it will be in line with this only.
Operator, sorry, I hope we have answered your questions. Param?
Yeah. Thank you so much, Sanjay sir.
It's 24 crores, not 30 crores.
24 crores. Sorry, my bad, Param. It's 24 crores.
Not 30 crores.
Okay.
Overall, it's 30 crores.
Yeah. Okay. Operator, in the interest of time, can you take one last question?
Sure. Ladies and gentlemen, due to time constraint, this will be the last question for today, which is from the line of Manish Shukla from Axis Capital. Please go ahead.
Yeah, good morning and thank you for the opportunity. So firstly, Rajiv and his team, will join AU after the merger, is there a tenor lock-in for the team to stay with the bank?
No, nothing like that, because it's more basis trust. It's more basis that, we want to work with each other, right? So I think that bonding is far, far better than, any kind of documentation bonding, because those are very highly experienced team, and Rajiv is working as an NDC of a bank. So we expect that, we should be given the same treatment, same respect. And we really want to make it a very happy merger where people come voluntarily, for the common cause and put their effort. So, but overall, yes, because we have appointed Avon Hewitt to advise us for a better integration, because people will have their own choices, people will have their own mindset, but the challenge can be to really how quickly we can align them. But I strongly believe the way we have built ourselves over the years, where people really had mattered us most, and we will continue to do that, and so no forceful kind of agreements, but very high on feeling kind of agreements.
Sure. These 700 promoters would infuse. Will it happen at the same valuation that AU is paying?
Yeah, same. Everything remains same, right? Yeah.
Yes.
No, I'm saying the 700 crore which they'll pump into the bank before the merger, that will happen at the same valuation for FinCare as you are paying for the bank.
Absolutely.
Okay. In terms of profits for Fincare, first half is 220 crores. Last year, full year was 100 crores. So are there any one-off in first half this year?
No. I think last year was more, they were still continuing to write off or clean up the book, which was post-COVID. And this year, the normalized operations have come in. So you can actually take the run rate of the first half year as a more normalized run rate as compared to what happened in the last year.
So what would be the proportion of recovery in this 220 crores?
120 crores is, 120 crore PAT you're saying?
220 crore first half profit, right? 219 crores.
220 crore first half PAT? Okay.
Yeah. What is the recovery number in that?
They are recovering about 10 crores every quarter.
Monthly.
Sorry.
It's 10 crore monthly.
10 crore monthly. Okay, so about 60 crores of this could be...
So before tax, right? 60 crores before tax.
Okay, understood. That's clear. Thank you. Those were my questions.
Yeah.
Thank you. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference over to the management for closing comments. Over to you.
Yeah, thank you, Michelle, and thank you everyone for participating. We really look forward to this merger. We have really hard on this in the last quarter, and it was very exciting and a lot of learning experience for the whole team, including myself. And we look forward to your support. Give us an opportunity, and we'll not prove you wrong. Thank you so much, and if you have any residual questions, you can always reach out to the investor relations team. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of AU Small Finance Bank, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.